Hello, everyone, and welcome to this second webinar in the series of webinars on the investment story. And today we are going to look at how to pick a stock from a sector, and we are calling this seminar Mining the Sectoral Landscape for Easy Stock Picking. So, I'm sure that you are founder of School of Market Studies, an online portal for get on and see how you would mine the sectoral landscape for shortlisting a stock. And today we are going to keep in the background the banking sector, on which we are extremely bullish, and because it consumes almost one third of the total market cap of the BSE or the NSE. It is a very important segment, and so we'd like to get on with it right away. So just wait a while till the webinar it till I share my screen, and there we go. Okay, so are we all set for this mining the sectoral landscape for easy stock picking with focus on the banking sector? So first, let us understand what is currently happening in the banking sector. We all know that the sector is significantly shrouded in a lot of smoke and dust, a lot of negative things happening with the NPAs and a lot of bank closures and all. So let's look at how primarily the trend of the PSU banks is shaping out. So what we see is that overall growth continues to be dull. Loan growth is barely 5% for the banks that have reported. However, retail lending is growing at 20%, and CASA, that is the mix of current account and savings account deposits, which are the cheapest cost of funds for banks, have over the last 2 years increased from about 25% of total deposits to about 33%, or every uh, 1 in 3 rupees deposited to the bank in terms of FD, savings, or as current account balances is from the CASA share. So with CASA, your CASA deposits are available at very low cost. So savings account give you 4 to 5%, some offer 6, and CASA and current accounts carry literally no interest. So these kind of accounts are the low cost funds for banks. Secondly, what has happened is that the most other pre-operating profit indicators appear benign or encouraging. So there's nothing wrong with them. They are very much okay. The other income and operating expenses, there has not been any kind of major upheavals as yet. However, the asset quality stress remains elevated. We know that banks have been forced to write down by the RBI and the new rules that have come in. So this has depressed return on asset, return on equities, return on equity, and this has been bad even prior to the fourth quarter when they had taken a huge hit. That time also they had very marginal profitability of 10 to 15 basis points, which when you compare with the private sector, which has got more than minimum of 1 to 1.5, is precarious. And what has happened is after booking these losses, the capital is just not available for the banks which have uh, been filed under PCA. So the PCA banks which are now restricted to lend are Allahabad Bank, Bank of Maharashtra, Central Bank Corporation, Dena Bank, Indian Overseas Bank, Oriental Bank, Union Bank, and Bank of India. So many banks constrained to lend. What do you expect to happen? Half of your banking universe in the public sector is not allowed to lend. So obviously the lending is going to go with the private banks, and they're going to increase their market share. So the boom in private sector banks will continue at the cost of the public sector banks. Okay, now before we get on to evaluating the uh, which bank we should be looking at, the one very important thing is we should be able to ascertain the industry background. So what we see is that the domestic credit in private sector is 52% of the GDP. That means our country is grossly underbanked. And as you can see, compared to the international markets, whether it be Japan, USA, UK, US, or China, we are one third of them. So there is substantial room to grow. And even if we assume that this share does not grow beyond 52%, and our economy, which is at about 2.26 trillion today, sorry, 2.8 trillion today, goes to about 5 trillion, then what we see is that the private credit available to for lending will actually almost double from 1.29 trillion to 2.26 trillion. And with the number of banks getting limited because of the constraints of the PCA, existing private sector banks and surviving banks from the public sector units will romp in the fields with market share gains. So if you are out of the PCA, great news, you're going to do well. So we have eliminated a few banks from a list which are in the PCA. So we have that is the first level of shortlisting that we have done, elimination, where we have deleted banks that we look at which are constrained from lending, right? So this is a snapshot of how the various banks stack up in terms of the assets under management or the loan book, the size of the loan book. And this includes all the banks, even if they are under PCA. Okay, so let us see. HDFC Bank has uh market share, has a size of almost 6,58,000 crores today, and it is expected to hit close to 10 lakh crores in FY20. Just in 2 years, from 6.5, it's supposed to add 3 plus lakh crores and grow to 9.89. So there's a CAGR growth of about 24%. Okay, now compare this with SBI, 23 lakhs, Big Daddy, right? And then we see the other banks which are there. So the big ones are Axis Bank with 6 lakh 41. Then you have Punjab National Bank with 6 lakh 11,000. You have ICICI Bank with 6 lakh 71. And then you come the fledgling banks, which are Bank of Baroda, followed by Canara Bank, Bank of India, and then the private banks come into play. At 2.03 is Yes Bank, and IndusInd Bank at 1.5, right? So this is how the banks stack up. Okay, now let's take a look at HDFC Bank. So if you were to just consider HDFC Bank, it has grown from 2,50,000 in FY13 to 6,58,000. So that is close to 3x in just a matter of 5 years. And normally, what happens when you have such kind of heady growth, you typically tend to expect that the numbers would kind of water down. And here, when the numbers are growing from 6.6 to 8.4 and to 9.9, one wonders whether this kind of growth is really sustainable. Can HDFC Bank grow at this rate? And for that, we have evaluated a system for the background check. So, what we have done is we have seen historically how HDFC Bank has grown. So, we have divided this period into 5 zones. One is prior to 2003, before the bull market. Then we had a huge run from 2003 to 2008. We have taken that. Then we had a fiscal stimulus period from 2008 to 2012. And then we had a slight recession, a mini recession before the government came in. That went on for 2 years, and finally we've uh, taken a growth period from 2015 till right till 22, so a period of 7 years. The reason for picking these 7 years, and we'll come back to that. So over this period, what you'll notice is that the GDP grew at 5.8% in the early 2000s. Then we accelerated to 7.8, 7.75, a shade below 7, and we are expected to grow at 7.6 over the next 7 years. So if you notice, broadly, we are growing at 7%. And during that period, the system loan growth, corresponding system loan growth up to 2000 was 17.7. Then during the boom time, it was 26.7, followed by the during the fiscal stimulus resorting back to 18%, then 14% in a mini recession period, and now it is expected to grow at 13.5%. Now, even before the growth picked up, HDFC Bank, the system, although it grew at such heady numbers, HDFC Bank grew at 93%. Then it was for 40% over the period 2003 to 2008. And then from 2008 to 2012, the growth was at 33%. And after that, we've seen growth in the range of 24.5% over that bad period. And then we are expecting to grow at 20% over the next 7 years. Now, is this possible? So typically we grew at about, the system growth was about 3x GDP, and which gradually came down to 2x GDP, and finally it was 1.8x GDP. And HDFC Bank grew 5 times the system credit and about 16 times the GDP. Then in this period, it grew at 1.5x the GDP and 5 system growth and 5.2 times, and so on. So we are expecting that this number will grow at 1.4 times system growth and 2.5 times the GDP. Okay, so this is how we have projected the growth to come in. And what we did is we compared the big boy SBI with the growth of ADFC. So SBI had a 1 lakh crore uh, loan book in the year 2002, and HDFC had a similar loan book of close to 1 lakh point 1 plus something in 2010. See, the base year is 2002, and for HDFC Bank, the base year is 2010. And over the period of the last 8 years, okay, HDFC Bank has, if you see, mirrored the performance of the blue line, that is the SBI. And this dotted green line is a clear expectation of how this growth is expected to pan out over the next few years, and which is closely mapping or slightly better than the growth of SBI for loan books. So this way of projecting that we have undertaken based on the growth of the economy, then considering the system growth and our assumptions, and then when we have taken these numbers and we have backtracked, what we find is that we are not too far away from what we are expecting, and hence whether uh, HDFC can continue to grow at 19.5% over the next 7 years, that was since 2015. If it was a question mark to you, then this graph is clearly answered. So, despite being a huge bank, SBI, HDFC Bank will continue to grow in this manner. And all the other private sector banks, now that the PSU banks are damaged beyond repair, will continue to exhibit this kind of growth. Okay, so what clearly happens is, and from this thing, what we can make out is that the private sector banks are all set to grow. So, what we have done is, on the various measures of comparison, metrics of analysis, financial analysis, we are comparing both the banks, HDFC and SBI, with their base shares given here on top. So, without getting too much into uh, the nitty gritty of this extremely uh, number heavy sheet, what I'd like, what I would like to point out to you is three factors, namely the ROA, which is the return on assets, the return on equity, NIM, cost of funds, NIM is net interest margin, the cost of funds, the cost to income ratio, and the capital adequacy, and obviously the NPAs. So, what you'll notice is that, okay, the return on asset of HDFC Bank over this entire period has always remained close to two times of what SBI has earned. So, if SBI was earning 1 rupee, HDFC Bank has earned 2 rupees return for every 100 rupees loaned. Okay, let's look at the return on equity to the shareholder. Basically, up until the good times and until the bank was growing, the return on equity has been in the high teens, 17%, 15%. And HDFC has also mapped that kind of growth. And considering the fact that its NPAs are expected to be much under control, just go down here where the cursor is, where the GNPAs and NPAs. So you see, uh, SBI is in 14, its GNPAs were 5.0 and 1.2 for HDFC. This is an old sheet, that's why it's not that much updated. And NPAs were 2.6 compared to zero point 0.4. So for every 1 rupee of non-performing loan, HDFC Bank had 6 of them. Okay. So considering that fact, your ROE is obviously significantly higher than that of SBI. Okay, see it halved here, the ROE. And look at the NIMS. So the NIMS are 2.8 and HDFC Bank is at 4.1. Cost of funds, they match each other. Uh, Cost to income ratio, HDFC Bank is far cheaper than SBI. And it has always been so. They have mostly been closely in line with each other. And the capital, and this is despite the fact that the salaries at HDFC Bank are far much higher than that at the SBI. And if you see the capital adequacy ratio, they were all in line, and now unfortunately things have turned sour. We look at these numbers in greater detail a little later. So on, you can clearly see that if you take HDFC Bank as a proxy for the other private sector banks, well, most of them, not Axis and ICICI, all the other banks have performed in very much a similar manner. Now see how the share of private sector banks has risen. Okay, in FY13, just 5 years ago, it was 20%, and today in FY18 we are at 33%. Okay, so we have put on almost 75% increase in market share. And as per Uday Kotak, the private sector bank share is expected to go to 50% by 22. But we believe that it could be around 45% from the current 33%. So obviously, private banks, because of growing market share, should be your go-to stocks. However, given the fact that we are underbanked and we will need banking services to grow, we have included a few PSU banks based on the criteria elimination, which we have taken from the NPA outlook. So, what we are doing is we are not restricting ourselves only to private sector banks, we are also including some public sector banks. And along with the private sector and the public sector banks, we are now going to shortlist banks based on how the NPAs have performed. So bad loans are the dogma for banks. And if you have got very bad numbers, we don't want to have them, right? So clearly, this is a chart of the net NPA levels of banks. Okay. from the period 2013. And what we have wanted to include SBI, so we are building a little bit of a bias here. What we believe is that without SBI, you cannot satisfy the corporate needs. SBI is 20. Just see in the last sheet, I'll just go back a bit. Okay, SBI today lends 20,000 crores, close to 20,000 crores, and expected to lend 24,000 crores in FY20 against 10 lakh crores of HDFC Bank. So without SBI, we cannot perform, and hence we would want to keep SBI in a short list. So while this is not the right way of doing the analysis based on screening, but what we have done is we have kept SBI because of the sheer size and magnitude of the bank and the important role it plays in the economy. So SBI's exit NPAs in FY20 are around 3. So any number which is drastically above 3, we have eliminated. So we have discarded Vijaya Bank, Union Bank, surprise, surprise, Punjab National Bank, Canara Bank, Bank of India, Whoa, Karur Vyasya Bank, and Axis Bank. So all these banks we have removed from our shortlist. There is another bank, you'll say Karnataka Bank, you kept it at 3.1. Well, so for the last 3 years, FY 18, 19, and 20, it is expected to be around 3. So it is not that damaging, and hence we have made an exception out here. So this is how we screen stocks. Now, going ahead, we have put in a second filter, that is the availability of capital to lend. So the RBI, to uh, prevent safety in the system, typically has a capital adequacy ratio, and which is typically divided into two parts, tier 1 and tier 2. So what we see is that the minimum tier 1 capital that is required is expected to be 9.5 for uh, FY19. So you have two ratios which are required, minimum CET and the revised minimum CET1. But what we have said is that we will just play with this number, which is the minimum tier 1 capital of 9.5. So if you notice, what happens is that automatically certain banks are further eliminated. So Bank of India will need funding. Okay, even after FY18, it will need funding. South Indian Bank will need funding, and Jammu Kashmir, which is there, will need funding. So what we have done is we have further pruned this list by two banks. Okay, but we have kept SIB in this list because apart from the fact that it is short on funds, generally its performance has not been that bad on the NPA levels. Let us check, right? So South Indian Bank, okay, has a watered down ratio of 1.6 in FY20, which is very, very agreeable, and hence we have included that bank and and kept it in our shortlist. Please notice these blue numbers that we have outlined in ICICI Bank. So ICICI Bank, despite having extremely high NPS, has a very comfortable tier 1 ratio of 13.1 in FY20. This is primarily because it is shutting down international branches in different countries and repatriating their capital. So it has been able to have a high ratio, right? So now then what happens is we come to the operations of the bank. Now in this, what we have done is that we have plotted the NIM on the y-axis and the cost to income on the x-axis. So first, let me come to what is NIM. NIM is nothing uh, more than the net interest margin. It is calculated by the interest earned less the interest expended divided by total income. And so we see that all these banks tend to have been crowded around the fact that the NIM varies between uh, 2 and 4, right? And if you notice, the NIM for IDFC Bank is 1.8. So not only is IDFC Bank having a very low NIM, its profit margin is low in lending, but also the fact that it has a very high cost to income ratio, which is about a little less than 60%. So clearly, this bank does not feature in our list. Now, let's see which other banks we would want. So, if we were to take a cutoff ratio of about 3, right, then what happens is this is your universe that you're getting. So, if you were to take a 50% cutoff ratio and a NIM of 3, what you would be left with is this universe out here, right? So our universe would further be shortlisted to the big boys in private sector: HDFC, Kotak, uh, IndusInd. We will keep IndusInd because the NIM is high, although it is above 50%. It is fine. RBL is there. And we have this entire pack of banks which we can consider, right? So out here, the banks which go out of this thing is Bank of Baroda, SIB, IDFC Bank. Okay, already JNK Bank is out. We had earlier eliminated it, if you remember. And let us see how these banks perform on the return on equity ratio. So this is the efficiency of the balance sheet, and you will notice that various banks earn from various numbers. Now, this SBI ROA of zero point 0.7 is in FY20. Mind you, all these numbers are for FY20. Okay. Uh, but before we go here, let's go back a couple of slides and then see and try to correlate these 3 slides to get a better picture. Okay. So, here what happened? Bank of Baroda went out of the picture. South Indian Bank remained out here, right? And again, what happened in this picture? IDFC Bank was eliminated, and we eliminated Bank of Baroda too. So what we are left with is the HDFC Bank, Kotak, IndusInd, City Union Bank or CUB, Yes Bank, Karnataka Bank, RBL, and Federal Bank. Okay. So what we have done is now from a bank list which we started off with close to 25 plus banks, we are now left with only 7 banks. That is HDFC, Kotak, IndusInd, CUB, Yes Bank, Karnataka, RBL, and Federal. So that's 1, 2, 3, 4, 5, 6, 7, 8. So we are left with 8 banks. Sorry, and we can include DCB also. We'll just keep it there, although it is slightly on the higher side in terms of cost to income. That is not too much of a worry because its NIM is very high. And C, DCB Bank's ROA is also pretty high for FY20. So now, if we were to, and of course, SBI would be there. So we had a universe of 10 banks. And within these 10 banks, what happens is that IndusInd Bank has a ROA of 2.3, okay, which is huge. So that is clearly number one for us. Okay, IndusInd Bank. IDFC Bank is very low on the ROA. So what we want to do out here is we want to filter out banks which do not have a ROA of at least 1. So what happens? SBI gets automatically eliminated. DCB goes out. right? Federal Bank goes out, uh, JNK Bank goes out, right? Karnataka Bank goes out. So what happens is we are left with the banks list now being further shortlisted to IndusInd Bank, HDFC, Kotak, CUB, Yes Bank, and RBL Bank. So now we have shortlisted our banking universe. We also will have ICICI Bank because it is very strong on that. Kotak, RBL, Yes Bank. So now we have seven banks given to us: Indus, HDFC, Kotak, CUB, Yes Bank, RBL, and ICICI Bank. Now we go to another level of checking, which we will do on the basis of valuation. And if you notice, is what we have done is we have plotted the ROE of the banking segment on the y-axis, and we have plotted the price to adjusted book divided by the 2-year CAGR growth. So sort of a peg ratio. We have replaced a P by G ratio with a price to adjusted book by G. Okay, so we are building in a proxy for the banking segment, and what we want to do is any number which is less than 1 is considered to be good. Now if you notice, uh, most of these banks are uh, quoting below half. So actually all of them become an investment worthy ticket item. But what we want is that we want a minimum threshold of 15% ROE in FY20. And in that, we have five banks that are given to us. So you have Yes Bank, IndusInd, City Union, HDFC, RBL, and Kotak Mahindra. So we are left with six banks: Indus, Yes Bank, HDFC, Kotak, CUB, and RBL. And big ICICI Bank, because of its low return on equity, it gets eliminated. So this is how we have shortlisted six banks for our investment analysis. And what we will now do is we will now go back uh, and see which is a very compelling stock idea. So although Yes Bank is giving you the highest ROE and it has got the lowest uh, price to book by growth, PB by G, if you could use that terminology. Yet, in terms of corporate governance and other issues, which are more uh, descriptive, qualitative aspects, uh, does not score that highly among these six banks. And so we will keep Yes Bank out, and then we are left with IndusInd, HDFC, Kotak, CUB, and RBL. Right now, let's get dive deeper into these banks, okay, and understand how do they compare with each other. So IndusInd Bank over the last 10 years has performed uh, in the guidance that they're given. They've not missed guidance even once. So they really know what they're doing. They have their act together, and they're on a acquisition spree. So they have recently taken over Bharat Financial, which is a microfinance bank, and they're also looking for uh, other growth avenues. So this is a growth hungry bank, and because its ROE is high, they can afford to get into some acquisition without diluting too much of their return on equity to shareholder. So that is a very good bank. If you see City Union Bank, it is predominantly a corporate bank. Okay. And with the market expected to turn around, the private capex cycle expected to turn around, this stock would definitely get a thumbs up because it would get kind of get re-rated upwards. Also at 0.14 times peg price to book to growth, you know, it is really sounding quite appealing. Then we are left with HDFC, RBL, and Kotak Mahindra. So HDFC, despite its huge size, is very close in terms of return on equity with that of IndusInd Bank and with City Union Bank. Okay, RBL's return on equity and Kotak Mahindra, they're all in the same range. So we have now shortlisted our universe to four stocks, that is HDFC Bank, Kotak Bank, RBL, and CUB, right? And of course, IndusInd. So we have five banks now. If you see, HDFC and Kotak are large size banks. IndusInd is a mid size bank. RBL is a fast growing emerging bank. And CUB is a small bank. So now let's go back a few sheets and just see how the AUM growth has happened over the various years. Let's just step back and see how it has grown. Okay. So if you notice RBL Bank here in this column, from 6,000 crores, it is carving out a journey to 73,000 crores by 2020. And in comparison to that, CUB, City Union Bank, which was three times its size in 2013, has not even managed to hit 40,000 crores. Okay, so clearly uh, RBL is outperforming this bank, and so just because you grow fast doesn't mean you're good. We need to see how you manage your NPL levels also. And so let's check out this sheet to see how the NPLs have moved. So just for these two banks, if you notice, RBL Bank, uh, its NPAs, these are your gross NPAs, are maintained in the ratio of around uh, 1.1, 1.4. Okay, slightly on the upside, but over the next 2 3 years, we're expecting them to remain pretty static. On the other hand, City Union Bank, which is at 1.6, is expected to come down to 1.2. So, mind you, they have got deviating trends. This is growing, and City Union Bank is collapsing. But because of the sheer size and the management, which has done the kind of growth at uh, RBL Bank, see, City Union Bank also has got good capital adequacy ratio. RBL Bank will need an injection of capital in 2021. City Union Bank does not need money. Okay, that is because it is not growing at the pace at which RBL Bank is growing. Mind you, every bank at some point in time needs to raise money. Now, if we check for operation of for operating efficiency, just these two banks, uh, RBL has a City Union Bank has a better metrics than RBL Bank, and if you check the return ratios, City Union Bank has a very high ROA compared to RBL, which is 1.3. So within these two banks, I think CUB definitely provides you with better metrics. So CUB Bank would purely become your play, but to my mind, RBL Bank, which is growing very fast and does not have too much deviation in terms of profitability than the two banks, would uh, be my pick over CUB. So we've seen that on all parameters, our CUB bank was being much efficient, also cheaper, had equal return on equity. But RBL is a hungry for growth bank. Hence, we keep RBL with our portfolio. And within the consideration of IndusInd Bank, absolutely IndusInd Bank is a must-own bank. So we are now left with four banks. We have HDFC, Kotak, RBL, and IndusInd Bank. So we have two large banks. We have RBL, which is a mid-sized bank, and IndusInd Bank. So between HDFC and Kotak, we would like to go with both, given the fact that Kotak has got a diverse business portfolio, and HDFC Bank, by sheer resilience and proven track record, must be included in every portfolio. So this is how, on the basis of analysis, we have selected four banks, and this is how we have mined the sectoral landscape for stock picking. So let's step back and just reiterate the steps that we took. Uh, Number one, we apprised ourselves of the current situation, and banks which were under PCA were obviously eliminated out of our list. Second is we tried to estimate what could be the growth of the Indian market, right? Then we eyeballed all the data to get a kind of sense of understanding of what is the size of the bank, how are they are moving, where are they headed, right? Then we took the leader in the segment to assess whether that growth is feasible on a large base. And when we compared it to SBI, we said that it is possible. Then we checked out how the two banks uh, confirm, and we said that HDFC Bank, being a proxy for the banking sector, would definitely be a cool bet. So private banks were going to be our focus area. Okay, then we saw how the market share of private sector banks is on the rise, and corporate honchos of the likes of Uday Kotak, when they speak, you have to listen to them because they really do mean a lot. So when they were saying we grow at 50%, we conservatively estimated around 45% by 2022. Then what we started doing was that, based on the criteria of NPA, how the NPAs happened to be in FY20 based on market forecasts, we kind of eliminated stocks where NPAs were greater than 3.0. So why did we do that? Because we wanted to include SBI in our portfolio of stocks. Why we wanted to SBI in our portfolio of stocks? Because it was a hypothesis that if you want to lend in this country, you cannot do it without big boy SBI. So we did that. Then we applied a second filter, which is of availability of capital, with whether they were qualified to lend. And in that, a few banks went out, like JNK, Bank of Baroda. Although SIB was also being exited, we kept it in our portfolio, in our list, because it did not have that dramatic uh, buildup of NPA, right? Then what we did is we checked the operational efficiency of the banks. We can compare the NIM to the cost to income, and from that we shortlisted stocks. Then we applied a second shortlist of stocks on return ratios. Here we had while City Union Bank and RBL shortlist were showing us that City Union Bank was better. However, when we went back again and eyeballed the growth, it clearly emerged that RBL is a growth hungry bank, and so we eliminated RBA CUB from our list. And then we had a minimum ROE cutoff at 15%. And because all the stocks were in the PEG ratio category, where they are less than one, despite them being in the high growth area, what we decided is that we will go with the banks which are above the line. Unfortunately, Yes Bank did not make it because of corporate governance. and SBI, South Indian banks, whom we had given the benefit of doubt, were coolly left behind. ICICI Bank too, because its return on equity was way too low, going ahead 2 years out. That's why we left it out. So that was a short and sweet presentation on mining the landscape. And having done that, I would like to introduce to you our second batch course, which we're going ahead, which we call the Master Course in Picking Multi-Bagger Stock Ideas. It's a online course which starts on 15 July. It will be hosted over 9 weeks with 2 sessions per week, which will be typically on a Thursday at 7:30 p.m. and on a Saturday at 2:30 p.m. There will be totally 18 classes. The first 4 classes will be an introduction to our proprietary 12 dimensions investment toolbox. This will be followed by classes 5 to 12, where we will do the analysis of 8 stocks across 8 different sectors. And we will also be taking into the consideration the transcripts and the con call recordings with the management. This will be followed by class 13 to 18, where various aspects of portfolio building, screeners, data mining and management, investor psychology would be discussed. And we would have the last class open, an open session where any of your doubts remaining would be addressed. The fees are 15,000 plus 18% GST. They are non-refundable and non-negotiable. So please don't call me telling me that you would like to have a discount on that. We don't want to peddle our valuable services at a discount. These video recordings will be available for offline viewing. PDF notes will be provided. And if you need more information, you can WhatsApp me on 7021216247 or email us at the School of Market Studies at gmail.com. Well, thank you, folks, and I hope you have enjoyed this presentation. In case you have not seen our previous presentation that we had done on integrating top down with bottom up analysis, where we discuss macro events and how you can inbuild them into your multi-bagger stock picking idea, please check out our YouTube channel on School of Market Studies, and there you can play the reruns from the videos that have been uploaded. So thanking you, that's all, and reminding you that we will be having another webinar on the 22nd of July at 7:30 p.m. same time. And let me tell you what the topic is going to be. The topic is going to be a very, very interesting one. It's thoughts on portfolio building, asset allocation, concentration, and diversification. And folks, we are going to introduce to you the concepts applied by global masters like Peter Lynch, Warren Buffett, and the likes of the greats. You have to understand one thing, that if if you have a stock which has gone up 10 times, but you have only allocated 2% to that portfolio of your portfolio, then you are not really making any money, right? Your 2% will go up 10 times. But let us say you are allocated 50% to a stock which went up 7 times, then you are making some serious money, isn't it? So here we will be discussing how asset allocation has to be done, what is the concentration, and how many stocks should you diversify in. So the timing is 7:30 p.m. on June 22nd. Please do log in and enjoy the show. Thanking you. That's all. Have a great evening and a very good week ahead.